Now, as we pivot to Europe, it's important to look at where we are on the hiking cycle, and the ECB is really the biggest laggard in the market, and it's one of the reasons why we think Lagarde, not to do a play on words, but we do see an increase in rates. And even though out of all the places that we've talked about, it's easy to point to Europe and say, you are clearly in a recession. But they are so beholden at this point to go up in rates because of inflation, and we'll show you some of the data sets on some of the big ones in terms of just how high inflation is as economic growth continues to peter out. So when we look at the Eurozone aggregate, you can look at manufacturing in general. Manufacturing came in at that one isn't updated, but it's about 48.1. Eurozone services 48.2. So composite is the manufacturing came in at 46, which brought us down to the composite of 47.1. So you're getting an idea that we are firmly in a contractionary basis. And when you look at the ECB coming to October 27th, they came and did nothing. They kept rates right where they are in terms. They increased rates by 75 basis points. And one of the key components is that we expect that to continue to happen. We expect an increase to continue, because they're going to have to continue to drive that forward, drive that higher, and they're going to get more aggressive to the same stance as the U.S. I just don't think they have the capacity nor the wherewithal to go as high as they need to. The biggest issue is going to be, where is their terminal rate and how do they stop this flight of capital? And one of the things that they've been doing is trying to defend the euro. They've been trying to hold it at about 98 in terms of against the dollar. And this is one of those ways that they can do it, is stop the carry trade, keep money here, but it's still, real rates are still firmly negative. And there's already talk of, well, what happens if inflation doesn't slow and we're in a recession? Are we going to ease? And the short answer, in my opinion, is no. Economic confidence came in right in line with estimates. Industrial confidence, same thing. Service confidence was positive, but well below estimates. And that's the service side is where we see some of the biggest overhang when you look at underlying growth. Consumer confidence came in at negative 27.6, not surprising, with CPI coming in well above estimates at 10.7%. CPI month over month, 1.5%, core holding firm. And then when you look at the Eurozone manufacturing PMI, it came in at 46.4, not 46, not 46.8. So again, you see that the pressure in general, and the manufacturing side is a bigger issue, because when you talk about Europe, especially Germany, which is a big entity to it, it's an exporting nation. So as manufacturing is slowing, it means you don't have as much to export, and you're going to have additional problems. And now that leads us into Europe, into Germany, where you can see the German manufacturing data was expected at 45.7, came in at 45.1. German services was expected at 44.9, came in right in line with bringing the composite, because of the big miss on the manufacturing side, at 44.1. That is a massive miss. That is steeply in a recession. And this is the largest economy in Europe. So when you think about the anti-fragmentation tool, which is buy Italian debt, sell German debt, at some point they're going to have to adjust. But Lagarde and the ECB is trying to buffer rates, get them higher before they start to pare this back a bit, because it's going to send Italian rates higher. And they're trying to provide some buffer, some running room before that actually occurs. Some of the leading data, business climate was expected at 83.5, came in at 84.3. Current assessment, same thing. Expectations right around the same level, but we're starting to see some of that slip again, with consumer confidence expected at negative 42.3, came in at negative 41.9. So again, very much steeply in a recessionary backdrop. GDP quarter over quarter, slight expansion. A lot of that was driven based on some of the government subsidies that came through, which provided some of that uplift. CPI month over month was expected at 0.6, came in at 0.9. year over year, expected at 10.1, came in at 10.4. So again, you're seeing those increases. Retail sales held in a bit stronger in September, but we see that weakening in October. Import prices came down a bit, which is a positive. But when you start looking at the underlying backdrop of inflation, there's still a lot of that upward momentum, which is going to weigh on just underlying economic strength, which is why the current account balance is still staying weak. Exports were expected at 0.5, came in at negative 0.5. Imports were expected at negative 0.6, came in at negative 2.3. And remember, imports are a good way to kind of get an idea of where exports are going. So imports falling more than exports. Again, there's more of those issues. This helped the trade balance in the near term, but we still see that moving in a negative trajectory. S&P Global French PMI was expected at 47.4, came in at 47.2. Services was expected at 51.5, came in at 51.3. So holding right at the 50 level. That's something that we think is going to weaken. But so far, France has kind of held in a bit in terms of the other areas within Europe, where France is kind of the bright spot at this point, which is funny to say in its own right, given the strikes and other issues they faced. But versus some of these other periods. And I think it's important to pause here and think about, well, why? And a lot of this is really coming to an energy side, not in a natural gas side, an oil side, a diesel side, but energy in general. But is when we look at some of the different pieces, I think it's important to understand nuclear power and the amount of nuclear power they have, where they have been able to keep some of their electricity prices lower than some of the other areas that we talked about, like Germany and the UK. They've still been elevated, but as that has pared back a bit, they've been able to manage because they also export some of this energy. So again, some of the electricity, so that helps, insulate a little bit, but still, there's still upside to come. When you look at PPI coming in at 28.5, some slowdown, but CPI still accelerating, was expected at 0.6, came in at 1%. Year over year was expected at 5.8, came at 6.2%. So you still have that movement up, and we see that rising again in November. Spain is just, PPI came in flat versus the prior. So again, that stopped going up. Year over year, PPI is still at 35.6, but that's for September. We know October got worse, so we do see that acceleration, and that's going to push up CPI, which actually took a nice little pair back, which is a positive, but it's not something that we think is going to be stable, just given where the underlying costs have gone to. Italy is a different story. Things are getting predominantly worse, and we don't see that pivoting at this point. So when we just look at economic sentiment declining a bit, the industrial sales, 23.1, again, moving in that direction. When you look at PPI, it came in at 3.5% year over year at 53%. CPI just surged. Everything was well above estimates in terms of where it should have been. And again, there's just so much pressure in the outset that we don't see that adjusting. And again, Italy is if we had to pick a country, and we know the pegs: Portugal, Italy, Ireland, Greece, Spain, because remember it's PIIGS. The Italy is the biggest concern here, and like glaringly so, where we see more and more of a problem as we head into into this year. And just putting this into perspective, the Euro area headline inflation versus the staff at projections. Euro area core inflation rose to 5.03% in October. The ECB may have signaled smaller hikes going forward, but a real pivot was just unlikely at this point. And if you just look at every stop, they've been, it's not only going to peak here, it's going to drastically drop. That has been the ECB stance since the beginning of COVID and the beginning of this acceleration. You get an idea of just how wrong they've been and how they continue to be wrong, especially in the backdrop of what we continue to see on a global level. Eurostat, when you look at just the core continuing to move up, then IMF continues to move down the economic forecasts. When you look at 2022, they've reduced things again, but they still have growth in 23, and that is where we massively disagree with the IMF, where we still have projections firmly negative. And again, they still have Germany at negative 0.3, Italy at negative 0.2, but again, it's going to be worse than that, especially in Italy when we look at the underlying problems that face those countries. ECB, again, trying to play catch up. As we were highlighting, they're trying to get to that level, but they're just falling short. And that's why they're going to have to stay raising rates. They've said it's going to be slower. I don't think they're going to have the ability yet to slow down. I think if the slowdown will be later next year. But when you look at exports, the Eurozone exports are continuing to drop exponentially based on the leading indicators, which we don't see improving. Negotiated wages and compensation per employee, when you look at it, are now firmly below the trend, moving further and further negative. And again, these are things that we don't see improving anytime soon. Euro area core inflation continued to accelerate. Again, nothing to show the stop. Eurozone inflation remaining much stickier than expected. And again, expected for some, not for those that have been watching us. The Eurozone inflation being sticky is not a surprise. If anything, we thought it was, it's even outperformed what we thought. And we were super bearish, and it's even above our views. And I would say that we were probably the most bearish, at least that I've seen on the European front, speaking on inflation, and it continues to move higher. So then when you look at that deposit facility rate, the increase of 75 basis points continues to be the driver. You know, we think it is likely that we get another 75 basis point before there is even a consideration of a slowdown, as consumer confidence in Germany kind of flatline, but you get an idea of just how low it is as Eurozone CPI continues to trend higher, Eurozone core continues to trend higher. But then when you start putting this into perspective against leading indicators, you get an idea of where that consensus is going and what the equally weighted GDP model looks like. And Nordia, I think, is closer to where it is in terms of where that is dropping to, of moving to the negative 4%, and how that growth is only getting worse overall in general. So then when you look at weaker growth, it should mean weaker yields. But as we've been saying, there's only so much that can be done because of the different backdrops. So the Taiwanese manufacturing PMI moving negative, Eurozone moving negative, new orders versus inventories moving further into contraction. So all of that should start to move those yields over. But the dynamics of the market are the problem because of lack of austerity, more spending, and this is creating, again, the market dynamics driving yields and rates higher. Then when we look to German GDP, it increased, defying survey data, but that is something that we do believe will be short-lived, and we will see that going further negative. So that's what we have for you on the European side. In the next segment, we're going to go deeper into China and Asia and some of the things playing out in that region.